Hey guys, Matt here with FXPM, and in this video I want to talk a little bit about the difference between price levels and price action. A lot of people call, what they're doing trading price action or trading the raw price, when in reality they're trading chart patterns or just normal support and resistance, which is kind of a form of price action. But you'll notice the way that we trade raw price movement. To summarize, it's how fast and how far the price has moved within a certain amount of time, and we're able to get statistical data on that and take trades based on high probabilities. So you'll notice a lot of people who would say they're trading price action would be looking at, let's say, the market has moved up, it's made a high, it's coming back down, and it's approaching to hit this resistance level. Now, a lot of, and let's say this is a 15-minute chart or 1-hour chart, whatever it is, or it could be a 5-minute chart. Let's do a 5-minute since the webinar and the training is typically on the 5-minute chart. Now, a lot of people that are trading just normal price levels, what a lot of people refer to as price action, would sell this area right here, this resistance level, no matter how the price gets up here, how long it takes or how long it hangs around up here. They're going to take this position and set their stop somewhere up here, set their target somewhere down here, have a good risk to reward and all that. But the way that we would trade this level here, we wouldn't necessarily jump in just because it's at this level. We jump in if it gets to this level with a certain degree of price action, how quickly it moves up. Because here's the thing, price is, think of it like a rubber band. A rubber band, you stretch it so far and it wants to snap back. And that's all these waves in the market. That's price extending and then retracing, or range bound, or vice versa. So a lot of what the software is doing is measuring those movements on a short time frame and giving you a probabilistic area when the market has been overextended. Now we take that overextended, let's say the price has been going straight up, hasn't taken any breaks or any retracements, it's giving us that overextended, it's in a red zone, and then we see it's at a resistance level. So we combine those two things to take the trade. And that's really the main difference between what I guess a lot of typical traders do, is they may take, we'll look at it like a common, where the price comes up, it kind of ranges, goes up, maybe, forms a bullish flag or something in here. And let's say your resistance level's right here. Some people will put pending orders in the market no matter what, sell at this level no matter what. Well, what's happening when the price is ranging right before a level like this is typically we're gaining steam to go break through this and either continue and break out, or do what would commonly happen as a false breakout. And so this price action right here, this raw price movement of, on a 5-minute chart, that's probably like 30, 40 pips, in one solid move would be about average for, let's say, euro dollar or pound dollar. This would be a trade where we would take it, after it broke out, if we've got some levels, some Fibonacci levels up here, we would sell it outside of this resistance area because it was building momentum, building steam, kind of like a sleeping giant or whatever, and it's getting ready to break that resistance level. Same thing for, a support level as well. So there's nothing wrong with looking at, flags and wedges and all these chart patterns, and by using our system, by no means do you completely get away from that. You can use it as a supporting factor for your trades to maybe hang on to a trade or have an idea as to whether your trade's going to work out on a longer term picture. But by combining this price action method, how far, getting into a price that's moving quick, a price that's running fast, and then it hits this level, it's likely to retrace for two reasons. One is it's overextended. The rubber band is stretched. And two, we're at this resistance level. So you combine those two things, it's very unlikely that the price is just going to keep going, you know, forever. Now, there are a couple exceptions. There's news, there's speeches, there could be other unannounced things like that that, you know, sometimes, it's very rare, but sometimes they'll catch you off guard. Typically, you'll see that come across a newsreader, or if you're subscribed to any news services, you'll see that come across. And by then, maybe you've taken a loss because you've jumped in front of something that was moving very erratic. But the point is, and what the takeaways are from this kind of conceptual theory with our strategy, is that when you combine price action, real price movement, price action, with good support and resistance levels, you're going to increase your win ratio, probably going to double your win ratio. When you're talking about, you know, you're about to hit a level, is that price, is the rubber band stretched? You know, if you can ask yourself that question every time you're getting ready to enter a trade, if the price is stretched out, then you know you've got a good chance that that resistance level or support level is going to hold. If we've been working our way up there slowly and it's been inching its way up to your level, you might be better off to wait, see if it breaks through. Worst case scenario, you're gonna miss a trade, but you know, you didn't take a loss. So that's today's lesson, is kind of differentiating these two and explaining how we use that with our strategy. So hope you learned something. Let me know if you have questions, and we'll see you in the next video.